Dr. Babasaheb Ambedkar Open University.
Hello my dear student, I am welcoming you to all in the video lecture series conducted by the Dr. Babasaheb Ambedkar Open University Ahmedabad in the Chaitanya studio for the course of BBA regular for the subject called BBA-202 Financial Management in block number 2, unit number 2, that is capital structure theory. While we evaluating the different types of finance, that is short-term finance, long-term finance, then concept of time value of money, then cost of capital, leverages, etc. At that point of time, we have to learn the very important and the key element or the key theory, that is capital structure theory. That means how you evaluate this capital in your particular business or enterprise or in a company. As we learn in a long-term finance, or in a source of long-term finance, that we determine the three main capitals are there, that is equity capital, preference capital and debt capital or debenture capital. So ultimately we have to learn the different capital structure theories also. So for this particular chapter, what are the learning objectives are that you understand the meaning of capital structure, then the list of factors affecting the capital structure, then theories of capital structure, then how the beta is related to the capital structure and explain the adjusted present value. So these are the different learning objectives of capital structure theory. Now let's begin our session with the introduction point, that is the plan that a company incorporates for its financing is referred to as the capital structure of the company. In other words, it is the finances that the company use in a long run, or we can say the long term. As a goal of any company or a firm, it is towards the increasing its value in a market. The capital structure of the firm should be planned or decided in such a way that is add to the market value of the firm. A company's capital structure can be termed as advantageous if the funds are used in such manner that is not only increases the firm's market value but also reduces the company's cost of capital. Now, what do you mean by the capital structure, my dear friends? The capital structure is how a firm finances its overall operations and growth by using the different sources of finance or funds. The debt comes in the form of the bonds issues or long-term notes payable in the form of the loan or debenture, while equity is classified as a common stock, preferred stock or retained earning. Short-term debt such as a working capital requirement is also considered to be the part of capital structure. A company's proportion of short and long-term debt is considered when analyzing the capital structure. When the people refers to capital structure, they are most likely referring to the firm's debt to equity ratio, which provides insight into how risky a company is. And usually a company more heavily financed by the debt having the greater risk, as this firm is a relatively the highly levered, or we can say the leverage. Now, what are the different factors affecting to the capital structure? The company used the fixed fund source, so for example debentures, term loan, etc., and along with the equity capital also, and this is known as the financial leverage. The firms generally make the use of equity to raise the debt, and the number of debt units of company holds per equity unit is called the company's debt equity ratio. It is calculated by the following formula, that is debt equity ratio is equal to debt divided by equity. And Ideally, the small scale industry must have the debt equity ratio of 3:1, while the medium and large scale industry must have the debt equity ratio 2:1, and a ratio of 3:1 indicates that the one equity units the company can raises the 3 units of debt, and while second is one equity unit the company can raise the 2 units in a medium and large scale enterprises or industry, we can say that. So this is what, my dear friends, ultimately the factor affecting capital structure, that is determining by the debt equity ratio, which is formulated as a debt divided by equity, and is standardized in a large, medium and small scale industry. That is for a large and medium scale, that is the ratio, standard ratio is 2:1, and for a small scale industry, that is standard ratio is 3:1. That means the one equity unit can raise the 3 units of debt, and subsequently in a medium and large scale industry, ultimately that is a 1 unit is equal to 1 unit of equity is equal to nothing but raise to your 2 units of debts. Next, the feature of optimal capital structure. An efficient capital structure should encompass with the different features. That is, the capital structure should be such that the dilution of a control should be minimal. Then the use of leverage should be optimum and at a minimum cost, leading to the company's prosperity. Then the capital structure of a company should enable it to raise the need-based funds as well as and stop the debt from a particular source if they are too expensive. And the capital structure should be flexible enough to sustain in the varying conditions. So ultimately at that point of time, my dear friends, the feature of optimal capital structure will be enhanced with these features, and at that point of time you determine your capital structure in an optimal way with the analyze and efficient use of your finances and funds. Next, the different capital structure theories. The two essential components of capital structure of a company are debt and equity. Hence, the proportion of debt and equity is very important in the capital structure. In other words, it is very essential to decide it, the level of financial leverage to be employed in the company. To decide this, it becomes necessary to understand the relationship that exists between the firm's cost of capital and its financial leverage. Some of the assumptions that are made to understand this relationship are: first, it is not expected for the net operating income to increase or decrease over the period of time. There is no income tax applicable, neither the corporate nor personal. A firm can alter its capital structure at any point of time without even bearing the transaction cost, or we can say the floating cost also. The company can pay its earning in the terms of dividends. That is, company can pay 100% dividend also. So this is what, my dear friends, that is capital structure theory. There are the two extreme view on whether there is exist any such things for the optimal capital structure. So in that way, there are the two main approaches are there, that is net income approach and not net operating approaches are there. In first, that is net income approach, assumes that the cost of debt and the equities are independent to capital structure. With high use of leverage, the weighted average cost of capital reduces and increase the value of firm's totality. While we evaluating the net operating income approach, it is assumed that the cost of equity increase and linearly with the leverage, and as a leverage charges, the value of the company and weighted of the cost of capital remain constant at both levels. So these two assumptions, or we can say these two approaches, are the very extreme view while we determining the optimal capital structure. that is net income approach, and second is net operating income approach. Moving towards the traditional view with respect to optimal capital structure, or we can say the capital structure theory. In a traditional approach, the cost of capital decreases, thereby increase the value of the firm, and this happens till a particular threshold is reached, after which the reverse happen, that is the cost of capital increases, thereby the causing declining in the value of firm. The traditional approach is the midpoint between the net income and net operating approach and is often known as the intermediate approach. Traditional view uses a good mix of debt and equity to increase the firm's value or decrease its cost of capital. This approach indicates that the cost of capital reduces within a certain debt limit and then increases. Hence, according to the traditional view, there exists a thing as the optimal capital structure when the cost of capital reduces or the firm's market value increases over there. On that, the next important point, that is Modi-Gilani and Miller hypothesis in the capital structure theory, or we can say the optimal capital structure theory. According to the Modi-Gilani and the Miller, that the net operating income approach explains the relationship between the leverage and cost of capital in three propositions. They have challenged the traditional approach by providing the rational reason for having the constant capital throughout all the level of leverages. The propositions made by the Modi-Gilani and Miller are based on the certain assumptions, and these assumptions are that first, that is trading of a security take place in a capital market that are perfect, and also there will be no transaction cost involved, that is the investors do not have to bear any cost for the buying or selling their securities. It is assumed that the investors behave rationally by choosing the risk and return that is most profitable for them. The profitability distribution value is expected to be same for the all investors. The firms can be clubbed together in one class based on their business risks. Then firms that have the same level of business risk can come under the one class also. Then there is a no tax incorporated, neither corporate nor personal. Then there is a 100% payout to shareholders, that is the shareholders are given all the net earnings by the firms. So these are the different assumptions are there for the Modi-Gilani and the Miller hypothesis. On that basis, on this chart you can evaluate the three proposals are then the optimal capital structure. On a y-axis, that given the market value of firm, and on x-axis 0 to 100%, that is given the debt divided by total value. The theorem A, B and C, at the level of A, B and C, the A is a straight line and B is a upward class and C will be the upward to lower class. At that point of time, and in between that leg of time 0 to 100%, that is optimal capital structure given. On that, there are three propositions are there for determining this Modi-Gilani and Miller hypothesis. That proportion number one, that the total market value of debt and the market value of equity, that is total market value of the firm, does not depend on the degree of the leverage and is equal to the firm's expected operating income at the rate pertaining to the risk classes. Thus, as per proposition of 1, the market value of firm is equal to nothing but your market value of equity plus market value of debt is equal to your expected net operating income or rate applicable to the firms based on the risk classes. On that second proposition, according to the proposition number 2, the cost of equity is the linear, that is directly proportional relationship with the debt equity ratio, and the firm required the return on equity increase as the debt equity ratio for the firm increases. This means the risk of equity holder increase with the debt increase in the capital structure. Then proposition number 3, the cutoff rate for the deciding the investment of the firm belonging to the particular risk class is not affected by the way in which the firm finances the investment. Thus, as per the proposition, since the financing and investment decisions are independent of each other, the financing decisions do not affect and the average cost of capital. Thus, according to the hypothesis or theory, the value of firm is not affected by the financial leverage. The cost like bankruptcy cost, agency cost, taxes, etc. are some of the factors that are found to be the disadvantages in this approach. So these are the 3 different propositions for determining the approach or theory or hypothesis for optimal capital structure. Let's move on to the next important point, that is CAPM and capital structure. The shareholders' return in the terms of EPS, that is earning per share, or return on equity is affected by the leverage, which also increases the financial risk. As a result, the beta of the equity of a firm increases since it introduces the debt in the capital structure of the firm. It is well known and it is ultimately well known that the individual security form a portfolio and each security has its own beta. And also the beta of the portfolio is nothing but weighted average beta of individual securities. So under CAPM model, I can say that is determining the different approaches, and for that beta calculations are important. While evaluating the CAPM model with the capital structure, you have to determine your first EPS, that is earning per share. This EPS and return on equity is affected by the leverage, which ultimately determine, or we can say, the increasing our financial risk. And while we are evaluating with this the debt and equity ratio, at that point of time the evaluation of the optimal capital structure and CAPM both are different. So CAPM is nothing but to evaluate what are the financial risks are there and how much level the risk can be the bear at a different point of time. For that, the beta calculation is most important feature in this capital structure or CAPM model. In the CAPM model, the risk-free rate and the market risk and the beta, these 3 are the main components while we determining the CAPM model. That is risk-free rate, which is called an RF, market risk or rate of market risk, that is RM, and third is beta. The formula for CAPM is nothing but the CAPM is equal to, that is cost of equity of CAPM is equal to RF plus beta bracket RM minus RF. So this is what, my dear friends, CAPM with the capital structure. Let's move on to the next point, that is adjusted present value. The adjusted present value is the sum of net present value of a project if the financed exclusively by the ownership equity and present value of all the benefits of financing. The main benefit of this approach is a tax shield resulted from the tax deductibility of an interest payment. Another one can be subsidize the borrowing, and the adjusted present value method of a business valuation is normally useful in the leveraged buyout. Since it has the tremendous amount of debt, so the tax shield is seizable. To be precise, the adjusted present value valuation model is the standard discounted cash flow method model. However, the cash flow would be discounted at the cost of asset, that is instead of weighted average cost of capital, and the tax shields at the cost of debt, and the adjusted present value and the standard of discounted cash flow gives the same result in the capital structure remain constant. For that, we can say evaluated by the mathematical expectation or the formula, that is base case NPV plus sum of PV of financing is equal to nothing but your adjusted present value. So these are the, my dear friend, the different concepts of the capital structure. Let's sum up with this particular unit. In this unit, we discuss the various concepts relating and associated with the cost and capital structure, different capital structure theories, different proposition of the approach, that is Modi-Gilani and Miller approach, optimal capital structure, proposition number 1, 2 and 3, then adjusted present value. These are the different capital structure form and concept relating to the capital structure. After watching this video, you have to evaluate yourself with writing this long question, that is, write different capital structure theory with example, which factors affect the capital structure of the company. Let's evaluate yourself with this multiple choice question. The first is, the dash is the sum of net present value of project financed exclusively by the ownership of equity and the present value of all the benefits of the financing. That is your adjusted present value. Next is, adjusted present value was first studied by the Stewart Mays of the professor at the MIT Sloan School of the Management, and then in 1973, the year of 1973, they evaluate the adjusted present value. So these two multiple choice questions is important for you and hope you learn well in this unit. After watching this video, after evaluating yourself with the long questions and solve this multiple choice question, you have to read further. Further means you have to read by these reference books also. The first is Financial Management by ICFAI, then Financial Management by the I.M. Pandey, then Financial Management by the P.C. Tulsian and Bharat Tulsian. After watching this video, after evaluating yourself with the long question and multiple choice question, after referring this particular reference books are also and study material, you justify yourself that you are the master in capital structure theory. Then you determine that the capital structure and the capital, the concept of capital, the concept of cost is very much important and easy manner that evaluating the all financial needs and financial aspects are there. So this is what we learn in the capital structure theory. Hope you enjoy this video. Hope you enjoy this particular session with enhancing your limitations and enhancing your limitless the study approach with the financial management subject called financial management. In that block number 2, unit number 2, the capital structure theory. Hope you learn well. We sum up this unit with this particular unit with this video, and then we will meet in the next session with the different unit and different block. Hope you enjoy this video. Thank you very much, my dear student.